Private equity as an industry is interesting because most of the introductory material you will find on this topic claims it's sufficiently simple in theory to be compared to the process of taking out a mortgage to buy a home. But go beyond this introduction and suddenly it's wildly complex. And it's frequently suggested that it requires a mastery of some higher form of financial science. In my opinion, the latter should be thought of largely as a marketing effort. Private equity does not employ financial wizards. It was dreamed up by humans and largely relies on arithmetic and vocabulary. Vocabulary aside, the process is simple, incredibly detailed, and at times wildly chaotic, but not the product of financial wizardry. What I would like to emphasize before we dive in is that detail and complexity should be separated. The best way I could think to illustrate this point is to quickly talk about the LBO model video series taught on the ASM platform. There is an illusion of complexity that surrounds this model. I've been running ASM since 2013, and between the three models, the three-statement model, the DCF model, and the LBO model, most people coming to this site for the first time freak out about the LBO model. In my opinion, it's largely on account of vocabulary. When you first look at an LBO model, there's all these new terms: sources and uses, balance sheet adjustments, exit analysis, etc. But in reality, what I like to emphasize is that mechanically, an LBO model is simply a three-statement model with some adjustments made to the balance sheet in the last historical period. And with the videos on ASM, you can watch me build a three-statement model from scratch in approximately 40 minutes. Now, you could claim that this is a simple approach, but even if you want to get more detailed, the additional line items rely on the exact same core relationships. The difficult parts are captured by the simple model, which, as an aside, is why this website is named asimplemodel.com. If you compare this annual three-statement model to this monthly and more detailed three-statement model, largely what you will find is more arithmetic. Think about it this way. If you understand this equation, how much more complex is this or this? Now, is it easier to have an error go unnoticed the more data points you include? Certainly. Is it more complicated? I'd say no. What I'm trying to say is that private equity is not complicated. It's just highly detailed, and transactions operate on tight timelines, so you rarely have as much time as you would like to close a deal. And that's what makes it chaotic, which means it really helps to know this stuff extremely well in advance. Now, can private equity be made complicated? Absolutely. By way of example, I've had to work on waterfall schedules that took weeks to build because negotiations between parties kept adding nuance to an otherwise simple structure. But the core framework, what you need to know to operate in this space 90% of the time, is teachable. It has to be because there are thousands of private equity firms around the globe and zero wizards. My last point, as part of this introduction, is that you're learning a new language. This will all sound like English, but if you don't make it a point to fully understand all of the vocabulary as you go and revisit definitions, you will get lost. So just pause and review vocabulary as you work through the content. To really help this point stick, consider that starting out, everyone focuses heavily on the model, but the model is just a form of analysis and communication. The transaction is captured by legal documents, and this is where the vocabulary really gets dense. The greater your understanding of this process, the more valuable you will be as a member of the deal team, which is why it's really exciting to be working with partners at Catton, an innovative law firm with 600 plus attorneys across the US to create this content. So with that introduction behind us, what is private equity? If I had to describe it as concisely as possible, private equity is the business of acquiring assets with a combination of debt and equity. Let's get a little more specific as it relates to what exactly is being acquired. As the name suggests, private equity is the practice of making investments in privately held businesses. In other words, cash is used to acquire ownership or equity. So technically, venture capital is also private equity. But venture capital and private equity differ in that venture capitalists are less concerned with a company's ability to consistently turn a profit. If a company is not consistently generating cash flow, then it is not a good candidate for leverage or debt, which, as we have discussed, requires interest payments to remain current. And in private equity, cash is king. For this reason, private equity firms generally steer clear of companies that are not yet profitable or that cannot return to some level of profitability in short order. There are exceptions, but largely this is true. And within the universe of profitable businesses, private equity firms are further defined by the scale they pursue. The middle market, for example, is broken down into three tiers. The lower middle market, which is focused on opportunities with 25 million to 100 million of revenue. The core middle market, which is focused on opportunities with 100 million to 500 million of revenue. And the upper middle market, which is focused on opportunities with 500 million to 1 billion of revenue. This private equity training course will focus on the acquisition of operating businesses with a history of positive cash flow, using this combination of debt and equity. This business is the asset acquired, In the taking out a mortgage to buy a home example, substitute business for home, and you have the basic premise. Now, in an effort to get readers up to speed expeditiously, in this lesson we will cover a few basic concepts, including the benefits of leverage, an example of leverage creating value, and an example of leverage destroying value, deciphering between items 2 and 3 above, an introduction to independent sponsors, and finally a comparison of independent sponsors and private equity funds. So let's get started with the benefits of leverage. The benefits of leverage are easily captured by comparing identical investments that differ only in the amount of leverage employed. If the value of the asset grows over time, the amount of leverage used to acquire the asset will enhance the amount by which shareholder value grows. Think about the two terms as follows. Debt is borrowed money that earns interest until it is repaid. There are two components to debt payments. Interest is the rate charged by the bank to loan capital to a borrower, and the rate is determined by the amount of risk assumed. Principal payments, which are defined by an amortization schedule, are payments made to reduce the balance of the loan. The final payment, known as the balloon payment, coincides with the maturity of the loan. For so long as the investment performs and principal and interest payments remain current, the remaining principal balance for interest-bearing debt will remain fixed. Equity, on the other hand, represents ownership. It's the value available to shareholders after all debts have been paid. It follows that as an asset increases in value, so does shareholders' equity. With that vocabulary in mind, let's look at two examples. Here we're showing the same investment acquired with different amounts of debt and equity. In both the equity investment case and the levered investment case, the shareholders own 100% of the same asset, even though $100 and $25 of equity was used respectively to purchase it. In year one, both investments grow in value by 5%, but a 5% increase on a $100 investment acquired with $75 of debt causes the equity value to grow by 20%, which compares nicely to 5% growth in the unlevered example. Note that value change and the cumulative value change are identical in both scenarios. The only variable contributing to the different return profiles, which you can see in the row labeled investment growth, is the amount of debt used to acquire the asset. Which brings me to my next point. In this course, we are exploring the acquisition of businesses with a history of positive cash flow. This cash flow can be used to further reduce the debt burden by paying it down over the course of the investment, which reduces interest expense and lowers the risk profile of the business. This terrific artist rendering, where EV stands for enterprise value, further demonstrates how this also benefits equity value. As debt is paid down, equity value grows both on account of this debt reduction and on account of the value of the asset, or enterprise value. As these simple explanations might suggest, the limiting factor for the private equity industry was not ingenuity. It was the availability of capital. Private equity gained popularity quickly as debt became increasingly available to finance what had previously been considered too risky. Now, the amount of debt available to finance an acquisition has fluctuated over time. In the 80s, easy money, which refers to lax lending standards, made outsized returns easier to achieve for the small number of private equity firms looking to benefit from this alternative investment trend. To highlight the benefits and dangers of excessive leverage, in the next chapter we will discuss two examples. The first was a wild win for investors in the early 80s, and the second, a modern-day private equity horror story. All right, team, that's all for now. Thanks for watching.